Thanks for clicking. Fixed mortgage rates are up from this point in time last month, as Canada's 5-year bond yields have hit their highest point in 2023, as hot inflation data coming in from the US has investors thinking that central banks will have to raise rates further. In fact, yields have reached their highest level since November 9th of 2022, back when 5-year fixed rates were sitting at 5.29. And the increase in bond yields and mortgage rates comes as Bloomberg conducted an interview with John Pasalis, President and CEO of RealEstate, a Toronto-based real estate brokerage. Pasalis told Bloomberg that affordability, due in large part to the interest rate hikes that we've seen over the past year, is worse than it was at the peak of the real estate boom.
The fact is, when you look at housing costs today, even though prices are lower with rates where they are, it's actually more expensive today than if you bought at the peak of the market.
But is that what the data says? So what I want to do today is go over my best mortgage rates heading into March, take a look at some shorter term fixed rate options, discuss whether or not Canada's real estate market is actually less affordable than it was when we had ultra low interest rates, and then go over what to look for next. Speaking of affordability, it is the end of the month, so we should get a better idea of the state of Canada's real estate market within the next few days, as the local real estate boards are set to release their data. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. First off, the best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down. You have a 25-year amortization. You qualify at 5.25 or 2 points above the contract rate, and you pay the mortgage insurance. The best 5-year fixed insured mortgage rate in December was 4.99, which dropped down to 4.79 in January and was back up to that 4.99 mark as of February, with a 5-year fully featured variable mortgage rate sitting at prime minus 1.05 or 5.65. So 5-year fixed insured mortgage rates did drop a little bit in January, only to bump right back up as of this month. Next up, insurable mortgage rates. Insurable mortgage rates, if you'll remember, that's where you do have that 20% down. You have a 25-year amortization. You qualify at 5.25 or 2 points above the contract rate, the rate that you're paying, and you don't pay the mortgage insurance. My best 5-year insurable mortgage rate in December was sitting at 5.14. That stayed the same in January at 5.14, but has since bumped up to 5.19 as of February, with a 5-year insurable variable rate mortgage sitting at prime minus 0.5 or 6.2%. So 5-year insurable mortgage rates up about 0.05%, but up nonetheless. And finally, my best 5-year fixed uninsurable mortgage rates. Uninsurable mortgage rates, if you'll remember, that's where you do have 20% down. You have a 30-year amortization, or you take money out of your home vis-a-vis a refinance or an equity takeout. You qualify at 5.25 or 2 points above the contract rate, and obviously you don't pay the mortgage insurance. Uninsurable mortgage rates have remained fairly stable over the past few months. In December, we had 5.24. That dropped down to 5.14 in January, and as of the end of February is sitting at 5.14, with uninsured variable rates sitting at prime minus 0.4 or 6.3%. There are some shorter term rates available, with a 1-year for insured, insurable, and uninsured sitting at 6.04, 5.74% for a 2-year, and 5.34% on a 3-year. So, fixed mortgage rates are going back up. But is housing any less affordable than it was during the peak of Canada's real estate boom in 2022?
Quite frankly, it's actually significantly worse than what it was when rates were low.
Let's take a look. The average price of a home at Canada's real estate peak was $816,720, and at that time, a decent 5-year fixed insured mortgage rate was 3.19. To buy that average home in February of 2022, using minimum down payment requirements and a 25-year amortization, we get a payment of $3,818. Fast forward to 2023, and the average price of a home in Canada is $612,200. If we use that 4.99 5-year fixed insured interest rate, we get a mortgage payment of $3,480. So, to buy that average home in Canada, not only does it take $20,000 less in down payment than it did a year ago, but we also have $350 less in monthly mortgage obligations. So it's not clear that that average home is any less affordable than it was a year ago. So maybe Pasalis was talking about variable rate mortgages, if buyers took variable rates a year ago versus if they took them now. Pasalis doesn't articulate his calculations, and Bloomberg takes his assertions at face value.
If the housing affordability is less so than when interest rates were at zero, how big a dialogue does this end up being for obviously all of the government officials that are trying to grow the economy for the long term?
So let's take a look ourselves. In February of 2022, a decent 5-year insured variable rate was prime minus 0.75 or 1.7%. Using the same calculations before on that average house, we get a mortgage payment of $3,233. Fast forward to 2023 and using a variable rate of prime minus 1.05 or 5.65%, we get a mortgage payment on that current average house of $3,708, or close to about $500 more per month than it was a year ago to buy that average home using a variable mortgage rate. So when Pasalis and others say that it's less affordable now to get into the Canadian real estate market than it was a year ago at the peak of our real estate market, it looks as though they're saying that if those buyers use variable interest rates. Yeah, as we've talked about a number of times on this channel, there are a number of home buyers who bought with variable mortgage rates at the peak of the real estate market, and I don't think that they would say that they are affording their home. That same home purchased in February of last year at $816K and prime minus 0.75% has now seen their payment bump up to $5,033 per month, or about $1,300 more than they were paying when they bought at the peak. So yeah, real estate was technically more affordable if you bought with a variable rate mortgage at the beginning of 2022. More affordable monthly payment wise, not so much in terms of down payment, qualification, or sustainability.
Does that matter?
When rates are sitting at near 0%, things are going to be a little bit more affordable. But as we're seeing with a 5.9% inflation rate, near zero interest rates cannot remain forever. That wasn't normal. And despite what we're hearing from these so-called experts, it's not clear that rates are returning to those pandemic lows anytime soon. As US inflation data continues to come in hot, more and more pressure is going to be put on our central banks, on the Fed, on the Bank of Canada to raise interest rates. So, in summary, fixed mortgage rates are up from this point in time last month. And despite what some are saying, it's not clear that housing is any less affordable than it was at this point in time last year, when interest rates were near zero. Food is less affordable, gas is less affordable, most goods are less affordable, but housing is not. With that said, we will continue to track the effect of mortgage rates on Canada's real estate market on this channel going forward. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.